And as the name says, simple average, it's very simple. So what you do here that periodically, probably end of every month, you calculate that what is the total cost for the inventory for which you have purchased during the month, and what was the number of the items. So the value divided by the quantity. So that's how the formula comes. Total cost was 20,200. You remember we had opening inventory 3,600, plus we made three purchases, 400 units, 400 units, 400 units, and the total cost was 20,200. And the number of units were 1,500, which was 300 plus 400, 400, and 400. And we calculate the average cost per unit, which is $13.47 in this case. And then we say how many units do we have. And as I told you earlier, that the number of units will not change. The number of units will remain 400. So 400 multiplied by 13.47, you come as 5388. Now this is a third value for inventory. So under FIFO method, it was 6,000. Under LIFO method, it was 5,700. And under simple average method, this is 5,388. Now the question is that if we have these three methods, which one we should use? The answer is that IS2, International Accounting Standard number 2, which deals with the inventory, it allows you to use FIFO method. I'm saying allows. I'm not saying that it urges you or encourages you or it recommends you. It allows you to use FIFO method. LIFO method and simple average method, they are not allowed. I mean, LIFO and simple average are not allowed. FIFO is allowed. However, there is a fourth method, which is called weighted average. Not the simple average, but weighted average. This is the method which IS2 recommends you or suggests you. Yes, if in certain cases you cannot use for some reason weighted average method, then you can use FIFO method. And I'm sure that most of the businesses, most of the companies in your local environment, they are using weighted average method. Weighted average method is a little bit, how to say, time taking. You cannot use it without the help of a computer program. Okay, let's see the weighted average method. This method is a little bit tedious. It is not very difficult. It is simple, but it involves a lot of calculations. And usually it is only possible if you've got a very good inventory software. You cannot do it manually. So what is the difference between simple average and weighted average? In simple average, what we did, we one time, probably at the end of the month, took the total value of the inventory and divided it by the number of units. So that's a one-time activity. But in weighted average, what you do, weighted average method, it requires you to calculate the average cost every time you make a purchase. So it means that if you are purchasing goods on everyday basis, on daily basis, you will calculate the average inventory value or average inventory cost on daily basis. So every time you make a purchase, a new average is calculated. So that makes the job a little bit, how to say, time taking or tedious. And of course, it is only be possible with the help of a software. So I'm going to use the same information, which we used in the last three examples. So we had on 1st of November, some opening inventory of 300 units and the cost was $12. So my total cost was $3,600. And then on 10th of November, we purchased 400 units at the cost of 12.50 and it makes us 5,000. So what do we have now? So we've got 700 units in our inventory, in our stock, and the total value for 700 units is 8,600. And since we made a purchase, therefore we need to calculate the new average cost. That's the rule. That's something which the weighted average method requires you. So what you do here, you divide 8,600 by 700 and you calculate an average of 12.29. So that's your new average cost. Now that's very logical. If you see that your initial cost was 12, then you purchase units at 12.5. So the new units are expensive. So naturally your average cost will go up. Then on 14th of November, you sold some units. If you remember in the previous example, we sold 500 units. So because we are selling 500 units and on 14th of November, our average cost is 12.29. So we will multiply 500 with 12.29 and we will arrive a value of 6143. So now what do we have? We've got 200 units in the inventory at 12.29, making me a total value of 2457. 8,600 minus 6143, you get 2457. And then you made one purchase for 400 units at $14, which means a total cost of 5,600. So what do you have now? You've got 600 units in your stock and the total cost of these 600 units is 8,057. So because you made a new purchase, you need to calculate the new average. So here we calculate the new average price. So we've got 600 units at $8,057 total cost. So we divide them and we get a 13.43 as new average. So remember, every time you make a purchase, you calculate a new average cost. On 21st of November, you sold some goods, 500 units, and this time you are going to sell it at 13.43. So 6714. So you are left with only 100 units in your stock at 13.43. That value is 1343. Then you made a new purchase for 400 units at $15. It makes you 6,000. So you've got now 500 units in your stock and total value of the 500 units is 7343. And because you made a new purchase, therefore you should calculate a new average. 7343 divided by 500, you get 14.69. So that's your new average. And now you are selling the last 100 units, if you remember from example. So this 100 units will go out of your stock at 14.69. 1469. Now please, one thing I must tell you, I mean, you should not be confused. This 14.69 is the cost which is going out. Now how much I'm selling it for, that's a different question. Maybe I'm selling it for $20 per unit, maybe $25 per unit, but this is the value, 14.69 or 13.43. This goes into the cost of sale in the income statement. This goes as an expense. So then what we have here, we've got our closing inventory of 400 units, and we will value 400 units at 14.69, which gives us 5874 as cost of as the closing inventory, and 14,326 it goes into your cost of sales. So now you've got another value for your closing stock or closing inventory. You see, we used 4 methods: FIFO, LIFO, simple, average, weighted average, and every time we've got a different cost of sale and a different closing inventory, which means a different income statement and a different balance sheet. And as I told you earlier, which method you should use, weighted average is the method which you should be using. If for some reason you find it difficult to apply for some reason, then IS2, it allows you to use FIFO method as well. But LIFO and simple average method, you will not use them under any situation. So here we got weighted average method, advantages and disadvantages. We say that FIFO, it is more realistic. Yes, obviously it makes more sense. First in, first out. That's very natural arrangement. First in, first out. LIFO, it's not permitted under IS2. Of course, this is your weighted average method. It could be complex, but weighted average method is required by IS2. Now, the last thing is what we say valuation effects in times of rising prices. Now, if you remember, when we did our inventory first section, I showed you some calculations in which I showed you that if the closing inventory value, it goes up, the profit goes up. Wherever closing inventory is more, profit is more. Closing inventory goes down, profit goes down. Actually, I should say that it is not about closing inventory and profit, it is more about closing inventory and cost of sale. Because if closing inventory goes up, your cost of sale goes down. And if cost of sale goes down, as a result, profit will be more. So closing inventory is subtracted from the cost of sales. If you remember, opening inventory plus purchases minus closing inventory, that gives you cost of sale. So if your closing inventory figure is bigger, because you are subtracting it from the total cost of sales, so it means your cost of sale decreases. So let's see valuation effect. It means FIFO. Okay, in our particular example, what we had, that FIFO method has a closing inventory of 6,000. LIFO had 5,700. Simple average had 5,300 something, and then weighted average again 5,700 something. So the highest value of inventory in our particular example was from FIFO. So FIFO, it meant higher inventory value, and higher inventory value means higher profits. So in this particular example, this is true, but it is not always true. I mean, FIFO is not going to give you always a higher profit, because sometimes FIFO will also result in lower profits. It depends on the value of inventory. We say, if you see, pay attention on the heading, it says valuation effects in times of rising prices. Because in our example, the prices were increasing. The opening inventory was 12.5, then we had 14, and then we had 15, etc. Because we were increasing the value, that's why this is the answer. Because if you remember, under FIFO, what happens? FIFO says first in, first out, which means the goods which come in first, they go out first. And your closing inventory consists of the last stock. Your closing inventory consists of the goods which came in the end. And in our example, the goods which came in the end were the most expensive goods, $15. And that's why our closing inventory was higher, 400 units multiplied by $15. Now, if we reverse the situation, imagine that if your prices are decreasing, if the prices are declining, so in that case, the last goods which you receive are the cheapest goods, are the goods with the lowest prices. So in that case, the closing inventory would have the least value, the smallest amount, the smallest value, and therefore the profit would also be lower. Okay, so now that is enough about inventories for ACC F3 level. Now what we need to do some practice questions, and I've already selected some 8 or 9 practice questions which I'm going to do with you. So you can watch the next video for practice sessions, which is also available in this section. And all what you need to do is you need to read the book, you need to read the notes, and you need to do a lot of practice.